So let me ask you something. You open your phone, you check the silver price, and it says 72 an ounce. Okay, cool. So you go to your local coin dealer or you hop on a bullion website and you try to actually buy some silver, and suddenly you're being asked to pay 85.92, sometimes even more. What is going on? Why is the price on the screen one thing and the price in real life something completely different? That's exactly what we're going to talk about today, because this is one of the most fascinating and honestly kind of alarming things happening in the financial world right now. And it has everything to do with paper silver, physical silver, Trump's tariff war, China's export ban, and a shortage that's been building for years. Stick with me, because once you understand this, you'll never look at a silver price chart the same way again. Okay, so first things first, what even is paper silver? COMEX, operated by CME Group, is the main exchange for silver derivatives, options, and futures contracts. While physical silver can technically be delivered through COMEX, the reality is that most trades settle in cash. Traders are not actually taking delivery of metal bars. They're making bets on price movements, rolling contracts forward, and closing positions for cash profits or losses. So when you see that 72 price on your screen, that is essentially a number being set by people who may never touch a single silver bar in their life. It's a promise. It's paper. It's digital. Now here's where it gets wild. For decades, global silver price discovery was firmly controlled by futures traders on COMEX and the London Bullion Market Association. Trading volumes in paper silver dwarfed the total stock of above-ground silver. At one point, the notional ratio reached as high as 356 to 1. In other words, the amount of silver promised on paper far exceeded the metal that could ever be delivered. 356 to 1. Let that sink in. For every 1 ounce of actual physical silver, there were 356 paper claims on it. The system only works as long as nobody actually asks for the real thing all at once, and then people started asking for the real thing. In early 2026, that assumption failed. COMEX data tells the story most clearly. Between early and mid-January, in just 7 days, 45 million ounces of silver were physically withdrawn for delivery. That meant roughly 26% of COMEX registered inventory disappeared in a single week. 26%. Gone in 7 days. That is not a small number. That is a system under serious stress. So why is this happening now? Why 2026? Well, there are actually several things that converged at the same time, and honestly, it's kind of a perfect storm. The first one is Trump. Now, love him or hate him, his tariff policies have completely scrambled the global silver market. There were worries that a tariff could be imposed on U.S. silver imports, aligned with a broader Trump policy, or more specifically Section 232 investigations around critical minerals, which silver was included in. As a hedge to that, a lot of metal started moving from London, the physical hub for silver, to New York, the futures hub, to hedge the basis risk between prices that could be embedded from any sort of tariff. So basically, traders and institutions started panic, shipping silver to the U.S. to get ahead of potential tariffs, draining silver from the rest of the world. And the numbers back this up. About 434 million ounces of silver are held in warehouses linked to the COMEX Futures Exchange in New York, roughly 100 million more than a year ago, when tariff-related trade disruptions intensified. So the U.S. has been stockpiling silver while the rest of the world runs dry. London, which is supposed to be the global trading hub, saw its stocks get absolutely hammered. Now, Trump did eventually pump the brakes. Silver fell more than 7%, retreating from an all-time high above 93 an ounce. As broad tariff threats receded, the decision reduced part of the near-term policy risk premium that had propelled silver to record levels. Despite the correction, silver prices remain more than 25% higher year to date. But here's the thing, even after Trump said he wouldn't tariff silver, the damage to the physical market was already done. The silver had already moved. The shortage was already real. And then there's China. This is the part that a lot of people aren't talking about enough. Starting January 1st, 2026, China implemented new export restrictions on refined silver. Under the new policy, only large, state-approved companies are allowed to export silver, and only after obtaining special government licenses. China is the world's largest refiner of silver. When China effectively turns off the tap, the rest of the world doesn't just feel it, it chokes. COMEX registered inventories in the United States are down nearly 70% since 2020. London Bullion Market Association vaults have lost around 40% of their holdings. Shanghai inventories have fallen to their lowest level in a decade. At current consumption rates, some industrial regions have barely 30 to 45 days of accessible silver reserves, 30 to 45 days. That's it. That's all some manufacturers have left before they run out of silver to build their products. And what are they building? Everything. Solar panels, electric vehicles, semiconductors, AI data centers. The electrical and electronics sector has been the biggest demand driver for silver, with consumption increasing 51% since 2016. Silver is literally inside the technology that is supposed to power the future, and we are running out of it. This is why the physical price and the paper price have split apart. Physical silver pricing on the Shanghai Gold Exchange has decisively broken away from Western paper benchmarks, with premiums reaching approximately 12 to 13% above LBMA spot and COMEX futures prices, a level that is exceptionally high by historical standards. And in some markets, it's even more dramatic than that. In major trading hubs such as Tokyo and Dubai, physical silver has reportedly been changing hands at premiums as high as 80%, with some spot transactions reaching 130 per ounce, while the paper price sat around 71 or 72. So what you're seeing when you go to buy a silver coin and the dealer wants your 85 or 90, that's not them ripping you off. That's the real market talking. When you go to buy actual silver coins or bars from a dealer, you're paying a premium over the paper spot price. And those premiums have widened significantly. The exchange for physical spread, which measures the difference between COMEX futures prices and London spot prices, expanded from a historic average of 25 cents to as much as 1.10 per ounce during recent tightness episodes. Now here's where the situation gets really interesting from a structural standpoint. Registered COMEX inventory sits at a mere 86 million ounces. Against this, the open interest for the March 2026 contract stands at 429 million ounces. This creates a stark 6-to-1 ratio between the paper position and the physical supply. In simple terms, there is enough silver on the books to cover less than 1/5 of the contracts that could theoretically demand delivery. That math doesn't work. And the market knows it doesn't work. If COMEX starts forcing cash settlements because they can't deliver physical metal, manufacturers face a problem. They can't stop production. If they stop producing, they make no sales, so they scramble to find physical silver elsewhere. And when that scramble begins, the physical market can break loose from the futures market entirely. You can't build a solar panel with a cash settlement. You can't make an EV battery with a promise. You need the actual metal. So what does all of this mean for you? Well, if you're someone who watches silver as an investment, the key takeaway is that the price you see on a screen right now may not reflect what silver is actually worth in the real world. The paper market and the physical market are telling two very different stories. From 2026 onward, the structural shortages that were previously papered over by drawing down above ground inventories are evolving into an overt supply crisis that can no longer be masked. The bottom line is this. Silver isn't just a shiny metal you stick in a drawer anymore. It's a strategic industrial resource that powers solar panels, EVs, semiconductors, and AI infrastructure. It's also being squeezed by geopolitics. Trump's tariff war pulling supply into the US, China locking down its exports, and years of supply deficits finally catching up to the market all at once. The paper price at 72 might feel calm, but the physical market is anything but calm. And history tells us that when paper and physical diverge this dramatically, something eventually has to give. Whether you're an investor, a curious person trying to understand what's happening in the world, or someone who just wants to know why their coin dealer is charging more than the spot price. This is the story you need to know. The great silver disconnect of 2026 is not a glitch. It's the market telling you the truth that the paper price is trying to hide.